What if I told you that two retirees with the exact same savings could end up with very different after-tax income, just because one withdraws their money more strategically? That's the part of retirement planning a lot of people miss. Retirement isn't just about how much you save. It's also about how you turn those savings into income in a way that keeps your taxes lower, it protects your government benefits, and it helps your money last longer. Now, the first step is understanding where your retirement income is actually coming from. For most Canadians, that can include CPP, OAS, GIS, workplace pensions, RRSPs or RRIFs, TFSAs, and non-registered investments. And here's the key. Not all of those sources of income are taxed the same way. For example, RRSPs and RIFs withdrawals are fully taxable. TFSA withdrawals are tax-free and generally don't affect federally income-tested benefits like OAS or GIS. Non-reg accounts can be more tax efficient depending on whether the income comes from interest, dividends, or capital gains. That's why withdrawal strategy matters so much. For example, it can make sense to start drawing down from RRSPs earlier than people expect, because spreading out that taxable withdrawal over many years can help avoid big spikes in income later. Think of it like draining a pool slowly instead of all at once. Slow and steady may keep you in a lower tax bracket and reduce the risk of triggering benefit clawbacks. And that actually brings us to OAS. For the 2025 tax year, the OAS recovery tax starts when your world net income exceeds $93,454, and the repayment is 15% of the amount above that threshold. So imagine 1 year you need extra cash. Maybe it's a cruise, or it's a second honeymoon, or even a second honeymoon on a cruise. If you pull that from a registered account like a RIF, that could push your income over that line. Now, pulling it from a TFSA probably won't. Same spending, but very different tax result. Now, there's another big opportunity for households. For couples, pension income splitting can allow spouses or common law partners to notionally split up to 50% of their eligible pension income, which can reduce the overall family tax bill. And this is really where financial planning becomes holistic. Your withdrawal strategy affects your taxes, but it also affects government benefits. It affects investment longevity. It affects estate outcomes, and even how much tax may be owed at death. That's why tax planning and retirement planning and investment planning and estate planning should never be treated as a separate conversation. So here's the key takeaway. Tax-efficient retirement income is not just about chasing one magic trick. It's a series of smart decisions over time. Which accounts to have, how those accounts are invested, which accounts to withdraw from first and when to withdraw from them, and how each choice affects the bigger picture. Because in retirement, it's not just about what you have that matters, it's what you get to keep.